Let's talk about Kirkland's Incorporated, KIRK, not to be confused with Kirkland's Signature, which is the Costco store brand, although their products are fantastic, and that would probably be more exciting than this one. Kirkland's Incorporated is a home decor store. Before you turn away, this is a legitimate short squeeze candidate. This is a profitable company with growth and an absolutely minuscule float. Hey everybody, Walrus here from Walrus Street, bringing you a DD today on Kirkland's Incorporated, KIRK. Just a reminder, in the spirit of Kirk, damn it Jim, I'm a YouTuber, not a financial advisor. This DD format today is going to be totally different than what I usually do on the channel. I have prepared a freaking PowerPoint, and this is to keep the video short. So if you want to look further into the PowerPoint presentation, I'm going to include the link below the video. As always, I aim for transparency on this channel, and everything in the PowerPoint presentation has been sourced with sources at the end of the presentation. So you're welcome. Your boy Walrus is looking out for your research needs. Let's get started. Kirkland's Incorporated, a powder keg of a short squeeze candidate delightfully packaged as a profitable home decor retailer. Those of you who have seen my channel, you know I absolutely hate the word short squeeze, and I do not use this lightly. So you have to understand that there's actually something real here for me to actually use this phrase. Links. Some of the important stats for the company. Market cap is only $337 million. The company makes comfortably more than their market cap in revenue annually. Current price per share, $25.01. Options IV 75%, which is a bit high, but when you factor we have a short week this week, earnings next week, that makes sense. Shares outstanding, only 13.48 million. Shares float, 12.59 million. And actually it's less than that, like I'll explain later. Average trading volume, super tiny, 151,000. Any volume and this thing blows. PE ratio for the company is about 12.04 to 9.4, depending on the source that you look at. And when we compare this to their primary online competitor, which is like Wayfair, Wayfair's PE is above 100. So yeah, here we go. Key points. Upcoming earnings, December 2nd before market. We have got 4 consecutive quarters of profitability with this company. And what's really critical here is they're increasing their gross margins up to 34.6% despite COVID-related supply chain difficulties. And you guys know that the way most companies are handling the COVID supply chain difficulties, the increases in shipping costs, etc., is that they're eating into their margin and trying not to pass the costs on to the customers. Kirkland's, however, has managed to direct source most of their products. I think on their last earnings report, they said up to 70% of their products are direct sourced now, and they haven't had to pass the buck on to their customers, and they've actually increased their gross margin, which is astounding for any retailer in this environment, let alone a small cap retailer. The company has numerous bullish institutional positions initiated just in the last week. We don't even have to go back historically. This is a legitimate short squeeze candidate with solid business fundamentals. Just to keep anybody's interest who's interested only in the short squeeze here, there's a low float available for general public trading, only 1.76 million shares available for public trading. That's crazy. The rest of it is held by institutions, hedge funds, and insiders. There's high short interest. The short interest is at 2.83 million shares, which you'll notice that's actually more than the shares available for the general public. High short percent of float, 25% down to 22.4 depending on the source. High days to cover. As of the last data that we have, 1029, somewhere between 17 days to cover and 7. And I know that's a really big spread, but on a short squeeze candidate, when you're talking about a difference between 7 days and 17 days, there's really not much difference. Anything over a week is obscene, and the low end 7 trading days is definitely more than a week. So the company is a specialty retailer of home decor in the United States. It has 369 stores as of Q2 ER across 35 states, and they've actually been cutting out their stores, closing them down, relocating, focusing on making the company more streamlined, more efficient, and their goal is to actually knock that store count down to 350. Their merchandise includes holiday decor, decorative accessories, art, mirrors, fragrance and accessories, lamps, artificial flora products, housewares, outdoor living items, which they're phasing out, gifts, and frames. Wake up! Wake up. No. I haven't even got to the best part. Don't fall asleep when you hear their products. The stores offer an assortment of holiday merchandise seasonally, and their 2 biggest seasons are Harvest, which is what they call it. I mean, it's Thanksgiving, it's autumn, and Christmas. Now, from their Q2 earnings release, Q2 is seasonally their slowest season. That's the summer season, and they were still profitable. Their net sales decreased 8% to 114.8 million with 4.5% fewer stores. The net sales decrease, a lot of that is attributable to the fact that their straight up closing down some stores. But also a lot of that is attributable to the fact that summer is their slowest season of the year by far. And the previous year, the numbers were artificially inflated because of the COVID pandemic. People were trapped at home, and all of the houseware, home decor places saw a big boom as people were trying to spruce up the insides of their prisons. Their homes. Gross margin increased to 34.6. EPS increased to 4 cents from -66 year on year. EBITDA increased year on year from 0.6 million to 5.4 million. This is awesome. And the cash balance on the Q2 earnings was 45.2 million with no debt. Again, I repeat, no debt. This is a retailer with physical locations that's carrying no debt. Awesome. Some highlights from the earnings transcript. They've been moving to direct sourcing, which improved their margins and alleviated supply chain issues. They're entering their harvest and Christmas seasons, which are the busiest of the year, with extra inventory being preemptively added to combat the supply chain issues. They're adding high-end furniture, vegan leather, because that's a thing. And they intentionally scaled back their marketing spend because they don't want to train their customers to only purchase at a discount. This is really cool. They just completed a $19.8 million share buyback, and they approved another $20 million share buyback. That's right. They completed a $19.8 million buyback, which was over 800,000 shares, and they just approved another 800,000 share buyback. This is taking what's already a low float of the company and making it even smaller, quite literally as we speak. Let's get into the financials. So their recent earnings overview, I'm going to go back to Q3 last year so you can get the entire year scope. Revenue that you can see is seasonally high. This is their harvest last year. This is Christmas last year. And then kind of tapers off throughout the year, lowest point during the summer. Net income peaks around the holiday season, which is what we're in now, and the rest of the year they're kind of operating at a loss, as with most retailers. In case you didn't know, Black Friday, which is going to be happening the day after Thanksgiving, it's called Black Friday because this is the time of year when retailers finally turn a profit. Most retailers, most brick and mortar retailers, operate at a loss throughout the year up until Black Friday, and that's when they go from being in the red to in the black, hence the name Black Friday. So it's not surprising to see the low income figures here for the spring and the summer for this company, and the high income figures for harvest and Christmas, which is going to be around that Black Friday time. Cash and cash equivalents, we've got 37 million back last year, a year ago. Right now we were sitting at 45.25 million. This might actually go down because of the share repurchase, depending on how aggressive they are with that repurchase. And net increase in cash and cash equivalents. It was a net loss coming off their worst 2 quarters of the year, but they're still sitting on a positive cash position. Recent earnings overviews, we can see for the last 4 quarters in a row, they have beat on their EPS, and we can see that they have positive earnings in 2021 for the first time in a really long time. 2020 was actually a negative earnings year. Some of the prospects, some of the interesting stats on the company coming from Simply Wall Street here, they have a really high return on equity. KIRK's return on equity, 42%, is considered outstanding. The industry average is 29%. This return on equity being so high indicates that the management is incredibly efficient. And when we look at the management increasing the gross margins in the middle of a supply chain crunch, this shows that the management of the company actually knows what they're doing. They're very experienced and they have a good grasp on this business. Future growth potential, this is their forecasted annual earnings growth, and this 8% came from Simply Wall Street, but it matches what they were saying on their earnings report. They were saying mid to high single digits, so 8%, yeah, that makes sense. Now, this isn't exactly a very high earnings growth, but we're looking at home decor. What do you really want? Again, KIRK is debt-free. Now, a negative. There's been a lot of insider selling for the last year. Only insider selling, no insider buying, and I do need to address this, and I feel like when we're looking at a company, you know, it's important to look at all aspects, the good and the bad. Previous to 2020, KIRK was actually trading as a penny stock below $1. So the valuation shooting up as high as it did, the only thing that I can speculate is that the C-suite, the insiders, wanted to sell to make some of their money back because they were probably holding bags from a penny stock. You know, imagine if your investment went up 20 to 40 times in a year, that's the time for profit taking. So when I look at this and I'm trying to think of reasons like why are the insiders not buying? Well, I look at it, most of them were tenured back into 2020 when this was trading as a penny stock on the COVID drop. So they were probably just super excited with their gains and they sold out of their positions. That makes sense to me from an investor's standpoint, but still, this is not a good look. Institutional buying, there's a ton of institutional buying, and you could go to Fintel, get all this information. Most of the positions initiated last week were actually bullish, and I noticed that a lot of them were married or hedged, and you'll see that I just very very hideously copy and pasted a bunch of these in here. But we have Jane Street with a call and a put, 2 Sigma, call and put, Citadel with a call and a put, D.E. Shaw with shares and a put, Susquehanna with call, shares, and put, B of A with shares and a put, Wolverine with call and a put, Peak with call, put, and shares, Group 1 with shares, call, and put, Goldman Sachs with shares and a put. You might be scratching your head and wondering what that means, and what I speculate is happening here. First off, they're hedge funds, so they're hedging their position with puts against the shares and calls. Secondly is, I have not seen this too many times where we have simultaneous openings and closings from so many different funds, so many different institutions coming in on a company just before earnings with so many calls and puts. I think these companies are expecting a huge move, and I think that they're going to be taking advantage of the IV both ways by opening up the simultaneous calls and puts. I would imagine that a lot of these are straddles that they're opening. The squeeze. The float is very low. The current shares float is just 12.59 million, but this gets even lower. The float available for general public trading, plebs like us, is 1.76 million shares. The company just completed the $19.8 million buyback and approved another 20, so this is going down. And the CFO herself in the last ER said the company feels that it is undervalued. So we've got insiders holding 6.7%, the public holding 13%, hedge funds 19.8%, institutions 60%. If you've been trading for a long time, you know that 3 of those groups typically don't trade their positions very readily. Institutions, hedge funds, and insiders don't readily trade their positions. That leaves us with just the 13%, the 1.7 million shares available to the general public that are slowly disappearing day by day as the company carries out another $20 million buyback. The short interest for the company is about 2.83 million shares. Webull's reporting at about 2.83. ShortSqueeze.com reported about 2.83. So I'm assuming that's kind of a consensus here. But what's really interesting is that 2.83 million share short interest is a lot higher than the float available for the public of 1.76 million shares. So there's really 2 ways to look at this short interest. You could either say that it's a high short percent of the float at 25% to 22% depending on the source, or you could look at this and say it's 160% of the float available for the general public to trade. Either way, 22 to 25 or 160%, the short interest is higher than the average daily trading volume and the shares that are available for the general public to trade, which is also the readily available shares to purchase on the market. This creates a very explosive situation. Because of the low trading volume, we have an incredibly high days to cover. Again, this is taken from FINRA data on October 29th, but it's somewhere between 17 days to cover and 7.7 days to cover with a trading volume average of about 151,000 shares. That's a really long time. I want to leave you with this quote: "The possibility of a short squeeze is one reason some analysts look at a high amount of short interest as a bullish indicator. Short interest is the fuel, performance is the fuse." A lot of times when you see these short squeeze companies pushed online, they're biopharma companies that are generating no revenue, that are waiting on the results of a binary event, and the short squeeze is the only reason to invest in the company. Or it's an EV company that has no revenue and a high short rate, and people think that it's going to squeeze for, you know, reasons. What we have here is a company with solid fundamentals, no debt, 8% year-on-year growth, and an improving business model going into its busiest season of the year. Let's go through my SWOT analysis very quickly. The strengths of the company, and I just want to list these off. Financially stable, profitable company with a solid cash flow. There are forecasts for mid to high single digits of income growth, around 8%. There's no debt in the company. The management is very intelligent, and they've simultaneously streamlined the business and improved gross margin amidst supply chain issues. They're entering their 2 strongest quarters, as the company dubs them Harvest and Christmas. Increased direct sourcing lowers the costs for the future as well. This means going into the future, their margins are going to continue to improve. They managed to remain cash positive despite Q2 being their seasonal low point. They've had 4 consecutive strong quarters, so there's no longer concerns that this is just a fluke. This is a pandemic company that's excelling for no other reason than people were stuck staring inside and buying new decor. They have low float, consecutive buybacks of 19.8 and 20 mil, and management has a perception that the company is undervalued, and that could propagate share buybacks even further. If they keep feeling they're undervalued, undervalued, they're going to keep buying back shares. Weaknesses. There has been insider selling. So on the opposite side, I have to say, if the C-suite is so confident the company is undervalued, why are they only selling and not buying? Possibly there's too many buybacks. 39.8 million total for buybacks is a large chunk of their income. They don't have debt, so could this money have better been used to give them a better strategic advantage? They intentionally spent a lot to guarantee their stock for harvest and Christmas. If their sales aren't as high as they anticipated, they're just going to be eating those losses and stuck with out-of-season inventory. They also backed off their advertising spending intentionally to ensure they weren't training their customers to only purchase sale items. This could seriously backfire and they could lose both on retention and new customers. Q2 is their slow quarter, but it was also, like really slow. You saw that decline year on year. Opportunities, institutional buying, and the nature of the institutional buys. We're seeing married positions with minimal downside hedging. This looks bullish. They're pivoting away from market competition with Home Depot and Lowe's with outdoor furniture and towards high-end furniture, possibly attracting non-budget clientele. There is legitimate short squeeze potential, though the short interest isn't as high as some of the other short squeeze targets at 22 to 25%, but the float is so low and the average trading volume is so low that the days to cover is somewhere between 7 and almost 14. So if this does squeeze, it's going to be a more slow burn than a sudden pop. Reinstatement of a rewards program that could bring in new customers or help with returns of the old ones. The company had canceled their rewards program a little while back, and they brought it back just in time for the harvest and Christmas season, which could generate new sales. Threats. Their competitors. This is a physical retailer. This is a brick and mortar store. So obviously they're going to be competing with Walmart, Bed Bath & Beyond, Target, Babcock, Michaels, Hobby Lobby, Pier 1, basically anybody that sells knickknacks. Also, their online retailers competing with them are Amazon, Pinterest, and Wayfair. Retail is cutthroat and there's little to no moat. If they screw up, they're done. They're going to go back to probably penny stock territory. If Q3 is unexpectedly bad after a slow August, then the short positions are going to be piling up as the institutions pivot from long to short positions on the company and the short interest rises. The current real estate market might force Kirkland's into less than desirable contracts for the 40 to 50 locations that they stated in their earnings report they want to move, and inflation tends to cut into non-essential spending. So home decor, well, at least to me, it's as non-essential as it gets. But then again, you guys see how I live. It's not exactly like I'm splurging on home decor here. The wrap. I know you guys always ask me about price targets. I don't do price targets. I don't do financial modeling. I'm a potato that knows how to type. I sit in front of a camera. I talk. I don't do financial valuations. So let's look at what the professionals have to say. Simply Wall Street, with their analytics, discounted cash flow, whatever the heck model they're using, they're saying the company is 69.4% undervalued and the fair value is $81.80 per share. That's a little bit higher. On Webull, there was 3 analysts that were reported covering the company, 1 strong buy, 2 buys. Average analyst price target was $36.33 with a range of 30 to 40. One big takeaway here, and this cannot be understated enough. I know people don't usually get excited about gross margins, but last quarter, which is their slowest quarter of the year, the company was able to increase their gross margins to 34.6%. If a smaller retailer like Kirkland's can manage to substantially increase its gross margins during one of the worst supply chain crunches in recent history, then their management is doing something very, very right. So what am I going to do here? I am going to take the plunge. Following the professionals' leads that we saw on Fintel, I'm actually going to be opening a long position in shares, a long position in calls, probably dated somewhere midway through 2020, and a short position in puts dated midway through 2020 to hedge myself. Now, you might think that that's silly and the puts or the calls, one or the other, is going to be a waste of money here, but if there is an IV spike on a squeeze, then I'm actually probably going to be making money on both the call and the put. So if I'm right about this squeeze potential, I'll be profiting 3 ways: the call, the put, and the shares, because the IV would increase so much that the put would actually increase in value. Remember, I am not a financial professional. All information in this presentation is for entertainment purposes only, and there's my sources. Let's take a look at the chart for Kirkland. You can see we hit a recent high of 34.45, and actually if we zoom out on the COVID drop, the share price went as low as 56 cents. Boy, it would have been nice to catch this one back then, but still, with a PE ratio of 12, when we compare it to the S&P average of like 34 plus or whatever the average is right now, this isn't super overpriced or anything. A couple things I want to point out to you. Since the bottom following their last earnings report, we've been hitting higher highs and higher lows the entire way up, and it's starting to look like we're at the bottom of one of those cycles and about to raise back up. Now, we have a strong support here at 17, and the RSI is kind of somewhere in the middle. The MACD is a bit high right now, but that doesn't really indicate anything future future looking. One thing that I am going to be doing on this, guys, because the support for the stock is around 1730, I'm going to be setting my stop loss, my trigger sell point at 1730. If the stock price goes below that after the earnings report for whatever reason, I just want to get out of it because I'm not really interested in holding a company that's going to be just giving me 8% gains. So I'm going to be playing this one super tight to the vest. I'm going to go ahead and put my auto sell at that point, that $17.30 level. And like I said, if it falls out, I lose some money, but I don't lose everything. Whatever, live to fight another day. That's it for me today. I hope you guys did enjoy this video. I know the format is totally different. If you did like this format, if you felt that it was easier to follow, if you felt that it was more concise, please leave a comment below and let me know how you feel. As always, if you want to support the channel, check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, good luck investing, and I'll see you next time.